Welcome back, everyone. This is Seewing Yee from the University Network and Richard at Benny from a Guarantee Rate Mortgage. And we're going to go over part two of our podcast. The part one we went over a week ago. You should have a video. You need to access that. Let me know. But this could be a standalone podcast as well. So we got a lot of information to share. So we have much more detailed information. We have all the market report for Lawton, Oklahoma, for sale, Oklahoma, and also the Performa on the two products, the single family home and the duplex product. So a lot of things to go over. This is a new market, very exciting, something that we've been preparing for a long time. Richard Avani, he's done a lot of blood and sweat and tears to vet this particular market, and he has all the network, all the resources available for our investors. So without further ado, Richard, go ahead and get us started.
Yeah, thanks, Seewing. And actually, just to clarify, I'm here representing my real estate brokerage, Bankers Invest, not guaranteed rate today, but I wear many hats, as I'm sure a lot of you guys know. But anyways, good to touch base with you guys. I am here in beautiful Oklahoma City at the moment, still in my RV, as you can see from the background. That's my windshield behind me. And I've been spending a lot of time in this market. I was here a couple weeks ago for a week. I'm back for a week just to make sure that I can do all the diligence and understand as much as possible about Oklahoma City in general, and then all the sub-markets. Now, keep in mind, I think I bought my first rental here in Oklahoma City probably 12 years ago, give or take. And I have 3 or 4 years. So I have a good amount of experience here and have friends and family and so forth that have bought here over the last decade. But what's happened, and it's happened all across the country in the last 3 or 4 years, is the properties that we were buying for $190,000, $200,000 now are $300,000, $330,000. So it's harder to make cash flow. It's impossible really to make cash flow in the markets that we're used to investing in. And that's what's super exciting about this opportunity with this particular builder who I've been working with for a long time, is he's developed a product that actually serves a huge need in housing, but also creates cash flow for us as investors. And what's even more exciting about that, and what we're here to talk about today, is one of the submarkets in Oklahoma City that we're focusing on, and that is Lawton, Oklahoma. And I'll share my screen here and pull up a little more information about Lawton, Oklahoma. But Lawton is a suburb. It's about 35 minutes from Oklahoma City proper. And the huge draw at Lawton is essentially, it's at the border or accompanying Fort Sill. Lawton ends, Fort Sill starts. And it really is a supporting town and community to Fort Sill. Now, and please note that we can share any of this information with you guys. Just reach out to Seewing and he'll share, obviously, the information. Now, what's interesting is Fort Sill, the military base itself, has 58,000 personnel there, 53,000, and that's including 20,000 military and civilian personnel, and then also the military family members. And as you can imagine, 53,000 people on this base is a huge amount of people. And unfortunately, I didn't prepare a map for this, but we'll try to get one for the next one. But you can see it's important to go ahead and look at Lawton, look at Fort Sill. It's essentially the same town, the same community. Lawton itself has 99,000 residents. And that's not including the 53,000 at Fort Sill. It is a smaller suburban town from Oklahoma City, but it's not small by any means. 100,000 people plus the military base is a good sized town. Now, as we mentioned on the last call, the interesting thing is there hasn't been new housing built in over 30, almost 40 years. And that's why this is such a good investment opportunity, because we're providing housing in a place that we're not projecting future growth, that it's going to need housing in the future, because for the last 30 years, it's needed housing. We're solving a current and existing problem. We're not forecasting in the future with the houses that we're building. We're building enough to satisfy the existing housing need. But with it being such a big town, on average, 30 to 35% of the tenants are either military or ex-military. And then the rest of them, a lot of people that live in Lawton are supporting businesses to that military community, whether it's a small business that's a restaurant or dry cleaner, or whatever it may be. There's a lot of the town, like most military towns, a lot of the town is employed supporting the military base the families, the amenities, and everything in between. Now, Fort Sill, and I know Seewing probably knows even more than about Fort Sill than me, but it's one of the most vital military bases for the U.S. Army. That's where they do their basic training and infantry training. And actually, they're bringing a lot more of the tech side, drones and stuff, to Fort Sill right now as well. Fort Sill has a very robust retirement community as well. People that end up serving there end up spending a lot more time and actually putting their roots there. Now, the most amazing thing, besides the fact that they give me the sex appeal of Lawton, obviously, is this military base. And we haven't even got into the numbers yet. The numbers are mind blowing. The cash flow and the entry point at which you can buy these homes is absolutely bonkers. And I'll play some walkthrough videos as well, so you can get an idea of the quality of the homes. They're very good. But you throw into the fact that there's a huge rental demand, there's a huge housing demand, and then you have the sex appeal of, hey, this is a massive military base that the government's still putting money into. It's not going anywhere anytime soon. It makes it really that diamond in the rough investment. And as real estate investors, we look for those opportunities that the mass public doesn't know about. Sometimes getting some of that inside information, which we have here in terms of the housing that's needed, that's where the big opportunities lay for investments. I'll move over here to some of the Performas. Now, the interesting thing, and I'm going to stop screen sharing here because I don't know if it shows me either, but the most amazing things about these properties. Now, I bought from this builder myself personally. I've done tons and tons of transactions with him. But when 3 or 4 months ago, he was telling me about the product, it sounded too good to be true. I was like, I need to go there. I need to see it. I need to touch it. I need to smell it. I need to understand the why and the how. And I'm about to tell you what he told me, that he's building brand new construction, single family homes. We're calling them cottages. The 2 bedrooms, 2 bath, really nice layout, granite in the kitchen, granite in the bathrooms, 874 square feet roughly. And these homes, actually, you know what? I'm not going to tell you what they're selling for yet. Why don't we do this? Why don't we go ahead and I'll screen share and we'll pull up a walkthrough video of one of these duplex cottages. Beautiful. I'm going to do a quick little walkthrough of this single family cottage so you can see it. I don't think it's playing the audio of it, which is good. But as you can see, you walk into the living room, very open layout, granite in the kitchen. I know those cabinets look green in the video. They're not green, I promise. Here's the first bathroom. There's a fenced backyard. And the fit and finish of the home, when you look at the baseboards, the coverage, here's 1 bedroom, walk-in closet. How they managed to accomplish walk-in closets of 2 bedrooms and 875 square feet is mind-blowing. Here's a 2nd bedroom. Here's much bigger bathroom, dual vanity. I apparently didn't walk in the closet on that one, but that one also is a walk-in closet. And once again, a shot of the backyard. And there it is. So you can see the fit and finish and the quality of the homes. They're very well built. They're brand new construction. And what these properties are offering us is, look, normally to buy high cash flow investment, we're buying properties built in the 20s and 30s and Cleveland, Ohio, or places in Alabama, maybe Michigan, places that generate high cash flow. And look, there's a lot of bad turnkey rehabbers out there, but there's a lot of really good ones that Seewing and I have worked with that do a really good job taking these older homes, buying them at auction, really doing a good renovation on them, putting a tenant in them, and then allowing us as investors to buy it all ready to go. But as good as you are at doing a renovation on a home that's 60, 70, 80 years old, it's still a 60, 70, 80-year-old home. These opportunities are allowing you to have higher cash flow than a lot of those high cash flow homes built in the 30s, 40s, but it's brand new. It's brand new. And it has the catch, the gimme, the sex appeal. And I don't even mean sex appeal, the hard data to support it as a good investment growth. And that's Fort Sill. So I don't mean sex appeal. It's, it sounds like a good investment. Supporting military risk, student housing, military housing. We've all heard that because they are very good, solid tenant bases that tend to weather most storms. And a huge thing too is the basic housing allowance given to the soldiers in that area, even entry level, is almost $1,200 a month. Guess what these properties rent for? Right about $1,200 a month. It's the whole model's built for these military people to be able to come in and not have to spend tons of money out of pocket. It fits right in their window. It's a brand new property. It looks nice, as you guys saw, but keep in mind, there hasn't been a new home built there in 30 or 40 years. No house in Lawton looks like these on the inside. The demand for these so far, as soon as they're built, they're rented. And they're starting to build a database of people that are interested in these. So I know I keep holding out information here and I'm building up the suspense, but I'm going to go ahead and pull up one of these single family homes here for us to review. So here it is right here. This is actually the one we walked through. I took this picture. What's amazing, I'm sure you guys can see that here right now, and I'll try to make it a little bigger. Yes, you are reading that right. $150,000 is the purchase price on this home. I know you have to chuckle at that. You're like, wait a minute, what's the catch? There is no catch. This is based on the builder. So a couple things on this. We've negotiated free property management for 1 year. The builder's also paying down 3% of the purchase price toward lowering the interest rate. And what's amazing is the last 3 or 4 years, as interest rates have gone up, 20% is down, has disappeared. It's available, but it just never pencils out. I'd say 5% of the loans I've done in the last 2 years have been 20% down. Most have been at least 25%. And the properties normally wouldn't support that. Guess what? 20% down actually works. It works very well on these properties. And if you guys look at this here, at $150,000 purchase price, 20% down, the cash on cash return is 7.7%. 7.7% cash on cash. And that's including a 4% vacancy. So that 234 cash flow, $50 of that set aside for vacancy. So the true actual cash on cash, if you remove that vacancy, it's north of 8% for a brand new construction asset. Now, here's the best part. 20% down plus closing costs. You can buy this home for 35 grand and it's going to rent for 12 to 12.50 a month, immediate cash flow. And this is 20% down. Obviously, you put 25% down, numbers are still super attractive. That's our duplex, which we'll get into next, but 25% down, 8.6% cash on cash return and 25% down. That's also still including a vacancy. And what's interesting, actually, let me slow down for a minute. 8.6% cash on a brand new home. No, this isn't 2010. This isn't 2018 when we used to be able to get those deals. This is today that you can get this. And that's why I'm so excited about it. Go ahead.
Yeah, absolutely. We're going back to the future. The movie Going Back to the Future.
Yeah.
Yeah. We're presenting a product to you have gotten 10 years ago. Okay. Amazing. Go ahead. Continue, Richard.
Yeah. And so another thing to note here, guys, is look, the national appreciation, the average appreciation rate over the last 40 years is almost 7%. I factored a very conservative 3% appreciation and a 3% rent growth. And one thing to note here on our Performa is we prepared like a 10-year kind of outlook on it. It says years to exit. I like holding my properties longer than 10 years, but after the end of 10 years, this property generates $130,000 in wealth building. And the breakdown of that is your cash flow. It generates $60,000 in cash flow in 10 years. Keep in mind, you're only putting $37,000 down on this plus closing cost. Not a lot of money that you're putting down. The principal pay down based on a 30-year fixed amortization schedule is just math. This isn't hocus pocus. So the principal pay down on this is $51,587. And the last number, the text in here is all jumbled. But the last number is the principal pay down. So 60,000 is the cash flow, 51,000 is the appreciation. Now keep in mind that's just based on a 3% appreciation rate. So this is just math. I think we can all agree less than 0.5% of the last 40-year average is a conservative rate to take for appreciation. And then the principal pay down, $18,670. Don't you love 30-year fixed rate? Sounds great, but in 10 years, that's all you paid out. That being said, the total in 10 years is $130,000, and that's based off an investment of $37,500. You've generated $130,000 in 10 years. And once again, this is just math. When I'll pull something else up here real quick, let's see if I can locate that. There we go. So I'm going to pull up this same single family home. I'm actually going to pull up this Excel that I used to build this. Okay. And I pulled that up because we have 3% appreciation, 3% rent growth. Let's say we change it to 2% appreciation and 2% rent growth. So just keeping up with inflation. Okay. I think we can all agree 2%, 100%, we're going to be able to hit the 2% average appreciation rate and rent growth. Look what that does to the 10-year exit here still. You're still looking at an $87,000 return in 10 years. It's cash flow, appreciation, and principal paid out. And that's going ridiculously conservative here. Okay. The reason I mention that is the wealth building in real estate is not from the cash flow. The cash flow is just a part of it. It's appreciation, it's principal paid out. And as you stay in the property longer and longer, let's say you held this property for 20 years. Okay. Look what happens to your total return. Cash flow, 111,000, appreciation, 72,000, principal paid out, 51,000, total return, $235,000. Once again, it's based on a 2% appreciation and rent growth. Statistically, it's 7% in the last 40 years. So this examples, I love showing this to people and letting them play with the numbers because this is math here. The principal paid out is math. This isn't an assumption. The appreciation, that is an assumption, but it's based on 2% per year, which is less than a third of what it's been historically ever. And then the cash flow. So yeah, these investments are ridiculous in terms of the cash flow that you get, 6.4% right off the bat in terms of the appreciation, in terms of the principal pay down. It's unheard of in this market. And that's why I'm back here. Granted, I've been on the road for 3 months visiting markets and racing. I race professionally as well. But I knew I had to come back to OKC after I left a week and a half ago because they're taking this product, this single family home, this cottage product, and building it in various areas across rural Oklahoma to the housing demand that's needed already, satisfying the housing demand that's already past due from being satisfied, which is a huge opportunity. In addition to the single family homes, there are also duplexes available, roughly the same cash flow, roughly the same purchase price. It's just you wanted to mix it up a little. They do have a little bit different of a layout on the inside. Here is the duplex picture from the outside. The purchase price on these are $320,000. So yeah, slightly higher than what those single family homes are, but you'll notice these are brick as well. And also they're built on obviously larger lots, which have larger cost than the single family home lots, but very similar. The finishes inside are all granite in the kitchen, granite in the bedrooms. They have a very good layout. There's 1,900 square feet. So 2 bedrooms, 2 baths on each side. And here are the numbers on these. Now, currently, you'll note the cash on cash is lower. And the reason is these do show management. So initially, the builder was only incentivizing management on the single family homes. Now he is incentivizing them on these duplexes as well. So even though this fantastic looking cash on cash return 4.8%, it will be closer to mirroring the single family home. So this 4.8 will be closer to around 6.5 to 7. In fact, I could probably pull that up. A fresh one. Here we go. Let's pull up the duplex. All right. So we got the duplex. Go ahead.
With the property management fee waived in the first year, the net cash flow will be additional $200, $349 according to this illustration to around $549 monthly net cash flow on these duplexes. So that's a reflection of the first year waiving of the property management fee.
Correct. Correct. And sorry, these need to be at 6.125. Okay. So here's what it would look like with the management waive the first year. So you're doing a 7.8% return, $568 a month in cash flow. That's including $100 vacancy reserve. So it's really $668. Looking at the 10-year return, obviously $245,000. And then once again, that's based on those conservative appreciation and rent estimates. Last thing I'll pull up is a quick walkthrough of one of these duplexes. There's the outside.
Very nice. Very
garages, of course. What's that?
Yeah, very nice brick construction. It'll stand up over time.
Oh yeah. So here's the layout inside. You can see everything's open layout. Appliances are included, granite countertops, stainless steel appliance, fridge at least, washer, dryer included. Big laundry room too. Here's one bedroom, nice size closet. You can walk in there if you're skinny enough. Here's a one bathroom, single vanity, but also granite countertops. You notice the floors, everything's made to be very tenant friendly. That way there's no repairs and things stand up to the test of time. Another big closet. And then of course you have the backyard out the rear. And here's the master bathroom, dual vanity, granite counters. Everything's light, everything's fresh, as you guys can see. Really nice layout. I like, obviously, the cottage single family home layout's even nicer, but for a duplex, the layout's fantastic. The light floors, baseboards, the fit and finish is actually really good on them as well for an economy housing product. Keep in mind, we're buying these at 150,000, but yeah, good sized rooms. Make sure to turn off the lights, put the AC back up. But yeah, really good layout as you come out into the living room as well. Having all the appliances included is great too. And then typically these are ready to go. Typically these will rent rather as soon as they're completed. So oftentimes as an investor buyer coming into them already being leased before you actually close on your loan, which is great. That's the goal for all of us. All of the properties are professionally managed by Next Homes. We work with a family run real estate office there that are actually realtors and property managers that manage over 500 homes in the Lawton area. They work actively with the military base. They're military certified as well. And they own essentially Lawton in terms of the real estate and management business. They're the largest there for good reason. They've been around for 20 or 30 years and they're very good at what they do.
Yeah, Richard, I'm even more excited than you are about presenting this product. I'm not, some members of ours are not aware that I spent 20 years in the U.S. Army way back then. More, so 20 years active duty U.S. Army. I retired back in 2002. When I was in active duty service, I was stationed in many locations throughout the U.S., including in Kentucky and in Texas. So I'm very much aware of the U.S. Army Force SEAL. They've been around for a long time. They can be around because they are mission essential. These are artillery units. I have a lot of friends while I was in military and ex-military who are stationed in Fort SEAL. But furthermore, when I was in active duty, my occupation title is finance specialist. Such a coincidence, Richard. I've been wanting to represent a location that have a heavy military presence because it's a very good real estate market. So as a finance specialist, such a coincidence, Richard. I'm so excited. When I was in active duty, as a finance specialist, Richard, I process soldiers who are coming in from another location. We call it permanent change of station, PCS. And I in process and out process soldiers. So when they in process through a army post as a finance specialist, I do their payroll, I do their finances, and I calculate their off post housing allowance. I do all that nitty gritty stuff, and
up your alley,
right up my alley. It's just mind boggling because I could visualize myself doing I can fast forward doing the paperwork. The military people, they have a on post, they never have enough housing. So mostly soldiers, especially when they are married, when they have children, dependents, if you will, they have to move off post. And many, historically speaking, all the military installations, they have to put people off post. So what I do is I incorporate this basic allowance for a BAH, basic allowance for housing. It's based on your grade level, your rank in the active duty rank, and how many years of service, whether you're enlisted or married, and then you are enlisted, or it's $1,250. This is a tax-free housing allowance. Is it mind-boggling? The soldiers' base pay are not impacted, are not touched when they pay the rent for the landlord. So $1,250, based on my calculation, based on the current basic allowance for housing, BAH rate, in this Lawton is like an E4, a specialist E4 with 2 years of service with 1 or 2 dependents. That's the housing allowance, $1,250. You know how easy? If you're a sergeant E5 with 3 years of service with a spouse, maybe one child, you have more than 1250 of tax-free monthly housing allowance. You could have 1350, 1400. For officer, first lieutenant with 2 years of service, or a captain over three with about 5 years of service, they have, I don't have the exact amount, they have the ability to pay off post housing around upwards of about $100. And one more thing, Richard, let me finish this up. Okay. Okay. When our soldiers are in active duty, they have an obligation. They are subject to UCMJ, Uniform Code of Justice, UCMJ, military justice. Your GI, you belong to the military, because if you screw up, if you do not pay your rent, it'll go into your record. If you want to have a career in the military, you better not screw up the rent, because tax-free rent, how could you screw things up? I'm not saying it's 100% guaranteed rent, even though a military and a housing allowance. It's just that it behooves you not to screw up, because it will impact your career. You can get kicked out. You can, if the rent is not paid, this housing allowance is not paid, one could go to the property manager, can go to the commander of the unit of where the soldier is resides, and then they can get into big trouble. Yeah, this rent is almost, I hate to say the word guarantee, but it makes this kind of product in this Lawton right outside for sale. The rental market will be stabilized for years to come. You could have a lower vacancy. You could have a very high quality tenant. I mean, not all tenant, Richard alluded to, are military, 30% or so, or military. Of course, the rental market is going to be strong for years and years to come. You expect low maintenance on a new construction. In fact, in the next 5 to 10 years on a new construction, you could have a very little capital expenditure, and the vacancy rate is very low. And those military soldiers who live in our posts, they're married soldiers. Their duty assignment is around typically at least 3 years. You could potentially have one tenant, military tenant, living being your high quality tenant for at least 3 years. Yeah, imagine you look at the calculation, the return on investment with low capital expenditure, very low maintenance, and a good vacancy factor for the long term. So it's really, as by owning these kind of properties in this location, you have the lowest risk possible. I know it's not 100% guarantee, nothing like that, but it's a low risk product. It's a long-term investment. So it's in all the features of the dimensional aspect of a rental property. As Richard alluded to, you got increasing cash flow. The tenant going to pay down your loan. You can have some tax benefit, which is amazing. I talk about tax benefit quite a bit on my videos recently. And then appreciation potential, the whole multiple aspects of associated with investment long term. Anyway, sorry to put so much of my feedback.
No, you're right in that. So your feedback's definitely valued, and getting an insider perspective obviously is great. So I think the most exciting thing to me, though, is a lot of us have properties that we bought 2 years, 3 years, 4 years, 5 years ago that have appreciated and they have equity in them. But the problem we all have is there's equity, but not enough equity to actually be able to go buy a couple properties. And a lot of us don't want to replace one for one, or we have our super low rate on the property, so it doesn't make sense. So a lot of us have trapped equity in our investment properties. As of this morning, I actually just listed one of my properties for sale. Sorry, I'm getting a call. I listed one of my properties for sale in that scenario, but I bought a couple years ago for 200 grand. It's break even cash flow. It's worth 300 grand now. Guess what? I owe about, on that one for 200 grand, I put 25%. So I owe about 135 right now. It's worth 300. So if I net $120,000 on this, at this price point, that's 4 of these single family homes. I'm going to trade one property for 4 properties that are actually generating lots of cash flow. So to me, that's the massive thing, is it's allowing me now to take properties that normally were like, yeah, there's not quite enough equity, because most investments are $300,000, $400,000 these days. Now here's a way to take one, turn it into 3 or 4, quadruple your cash flow position, diversify the risk on that one asset, and grow your portfolio.
Richard, you are not going to find no one in the country right now. Richard, you are now the pioneers. We're the frontiers of the modern day frontier. Why? You're not going to find a high quality cash flow plus appreciation market for a single family home brand new for only $150,000 for a single family home, and for duplex for $320K brand new in an emerging growth market. This is mind-boggling. You're not going to see. We have done all the legwork, most of the legwork, most of the research. We vetted everything. We vetted our network. Richard and I have known the market all these years. We diversify our portfolio in many different markets, and now we're turning back the clock. This is truly once in a lifetime opportunity to not only to use what Richard just described from his existing equity to sell one of his properties from your vast portfolio, Richard. You can parlay into 4 rentals with 20% down payment. But there's so many different ways you can buy this low cost product. 20% down payment, 35 grand, including closing costs, seller credit, everything else. But who cannot come up with 35 grand to buy this low cost, low risk product? Furthermore, you can use your self-directed IRA. A lot of people have a whole bunch of $1 trillion of IRAs available. People couldn't even tap into it. You can use your self-directed IRA to buy, in the name of the IRA, to buy this kind of product. Slam dunk. This is a slam dunk market, slam dunk product. Invest for long term and he's almost passive. Everything's done by the property management mostly. As Richard alluded to, when you have in excess of 20 rental properties and the monthly time out of your time is 2 or 3 hours out of your time to managing your portfolio, because that's how we do it. Long distance, remote, passive, almost passive investing, but still under your name, directly. Your name is your product. You're not partnering with anybody. You're not doing syndication. You're not doing all this weird high risk flip and all those burst strategy, BRRR. Those are just high risk. This is a very not sexy. You try to achieve financial freedom using our business model. It's not sexy. It's kind of boring, but that's good. You just stay the course long term. That's what it's all about. Richard, go ahead.
Exactly. I just guess the opportunities are definitely there. I know a lot of people get very excited about these. They're moving very quickly. So if you are interested in one of these, there's a product that is a couple weeks from completion. I think most of them that are completed are already rented. There may be a couple, but reach out to Seewing and we will get you guys squared away and get you some more information. Appreciate the opportunity to present these.
Absolutely. And these kind of products go fast because Richard's network, your network can have a lot of ready buyers, my network as well. 5% down payment, earnest deposit. These houses are already, you can cash flow from day one. And yeah, you contact me first so we can do a complimentary consultation so I can go over your goals and your objectives, your strategy, and get loan pre-qualified by Richard. He also does, obviously, loans. So we are one-stop shop by every stretch of the imagination. So that's pretty much it. That's all I have to say. Anything else you have to say, Richard?
That is it.
Thank you so much. Thank you for watching. Have a nice day. I'll see you guys on the other side. Bye-bye.